What's up, everybody? It's the Investment IQ Insights team. And in this video, we're diving headfirst into the world of undervalued growth stocks. These are companies that are poised for some serious growth. And right now, the market just isn't giving them the credit they deserve. But that's our opportunity. Remember those times you wished you jumped on Amazon or Apple before they became, well, Amazon and Apple? This is your chance to potentially get in early on the next big thing. But listen closely, because picking winners is about more than just hype. It's about understanding the fundamentals. Over the next few minutes, we'll break down 5 companies that have caught the attention of Investment IQ Insights. From their financials to their growth potential, we're leaving no stone unturned. So grab your notepad, get ready to take some notes, and let's get started.
First on our list is Academy Sports and Outdoors, ticker symbol ASO. Academy is looking like it's on sale. This company is a sporting goods and outdoor recreation retailer. They've got a solid current ratio of 1.62. Their forward PE ratio of 7.44 is exciting. It's significantly lower than the market average. Their debt-to-equity ratio is 0.90. It means they're not drowning in debt. Analysts project earnings to grow at 14% annually. Academy is perfectly positioned to capitalize on the outdoor trend. They're financially sound and undervalued by the market.
Next up, we're taking a look at Axos Financial, trading under the ticker symbol AX. Now, Axos is a digital bank, and in today's tech-driven world, digital banks are gaining some serious traction. They've got a forward PE ratio of 9.82, which is lower than the average for the financial sector. That tells me that the market might not be fully appreciating Axos's growth potential. Now, I know their current ratio is a bit low at 0.43, but that's not uncommon for banks. What matters is that they're managing their assets and liabilities effectively. And speaking of managing things well, their debt-to-equity ratio is a healthy 0.28. That's a good sign, indicating they're not overly reliant on debt financing. But here's what really gets us excited about Axos: their focus on technology and innovation. They're not your typical brick-and-mortar bank. They're all about providing a seamless digital banking experience, which is what consumers are demanding these days. Analysts predict their earnings per share will grow by an average of 10% annually over the next 5 years. Again, not a guarantee, but it shows they're expected to keep growing at a decent clip. Now, the financial landscape is constantly changing, and Axos will need to adapt to stay ahead of the curve. But with their digital-first approach and commitment to customer service, they're well-positioned for the future. Overall, Axos Financial is a company that's riding the wave of digital banking. They've got solid growth potential, a reasonable valuation, and a management team that's focused on innovation.
Now let's talk about MI Homes, ticker symbol MHO. This company is a home builder. And with the housing market being as hot as it is, MI Homes is in a prime position to capitalize. Their current ratio is a whopping 6.97. That's right, 6.97. That's like having a stack of cash ready to handle any short-term obligations. It shows they're managing their finances extremely well, and their forward PE ratio of 8.13 is also quite attractive, suggesting they might be undervalued by the market. It indicates that investors are getting a good deal for the company's earnings potential. Plus, they have a debt-to-equity ratio of 0.38. That's low, which means they're not overly reliant on debt to finance their operations. It gives them more financial flexibility for growth and expansion. Analysts project their earnings per share to grow at an average annual rate of 12.50% over the next 5 years. That's some solid growth potential, especially considering the current demand for housing. Now, of course, the housing market can be cyclical, and there's always a risk of interest rate hikes impacting affordability. But MI Homes has a strong track record and a focus on quality construction, which should serve them well in the long run. They're operating in a market with high demand, they have a strong financial foundation, and they're expected to continue growing their earnings.
Moving on to UFP Industries, trading under the ticker symbol UFPI. Now, this one might not be as flashy as some of the other companies on this list, but don't let that fool you. UFP Industries is a manufacturer of wood and wood alternative products, and they've been quietly building a solid business. Their current ratio is an impressive 4.79, indicating they have a strong ability to meet their short-term financial obligations. That's like having a fortress of cash flow to navigate any economic uncertainties. And check this out, their forward PE ratio is 14.36. While not as low as some of the others, it's still reasonable considering their growth prospects and financial health. Speaking of financial health, their debt-to-equity ratio is a minuscule 0.13. That's incredibly low, which means they're using very little debt to finance their operations. It's a sign of financial prudence and stability. But here's the real kicker. Analysts project their earnings per share to grow at a whopping 17.00% annually over the next 5 years. That's right, 17%. That's some serious growth potential, driven by the increasing demand for their products in various sectors. Now, UFP Industries might not be a household name, but they're a key player in a growing market. They've got a rock-solid financial position, a history of profitability, and they're expected to keep growing at an impressive rate. They're a bit of a hidden gem, quietly generating value for their shareholders while operating in a sector with long-term tailwinds.
Last, but certainly not least, we have PayPal Holdings, ticker symbol PIPL. Now, PayPal is a household name for a reason. They're a leader in the digital payments space, and their platform has become essential for online transactions. Their current ratio stands at a respectable 1.28, indicating they have a healthy ability to cover their short-term liabilities. It shows they're managing their cash flow effectively in a rapidly evolving industry. While their PE ratio of 12.97 might seem a bit high compared to some of the other companies on this list, it's important to consider their growth trajectory and market dominance. And speaking of market dominance, their debt-to-equity ratio of 0.56, while not the lowest, is still manageable. It suggests they're not overly reliant on debt to fuel their growth, which is always a good sign. But here's what really excites me about PayPal. Analysts are projecting their earnings per share to grow at an average annual rate of 15.93% during the next 5 years. That's some serious growth potential for a company that's already a giant in the industry. Now, the payments landscape is becoming increasingly competitive, with new players constantly emerging. But PayPal has a massive user base, a trusted brand, and a constant drive for innovation. They're well positioned to continue benefiting from the growth of e-commerce and the increasing adoption of digital payments worldwide.
So there you have it, our top 5 undervalued growth stocks to buy now. Remember, these are just the opinions of Investment IQ Insights, and you should always do your own research and consider your own financial situation before making any investment decisions. Investing in the stock market always carries risks, but it can also be incredibly rewarding. By identifying undervalued companies with strong growth potential, you're putting yourself in a position to potentially benefit from their success. If you enjoyed this video and want to see more content like this, make sure to hit that subscribe button and ring the notification bell. And hey, while you're at it, check out these other videos now appearing on the screen. We've got a ton of great information on investing, personal finance, and building wealth. Thanks for watching.